Welcome to today's market report.
Wall Street's major indices closed lower on Thursday as concerns mounted ahead of closely watched monthly non-farm payrolls numbers due on Friday that the Federal Reserve's aggressive interest rate stance will lead to a recession. Markets briefly took comfort from data that showed weekly jobless claims rose by the most in 4 months last week, raising a glimmer of hope. The Fed could ease the implementation since March of the fastest and highest jump in rates in decades. The equity market has been slow to acknowledge a consistent message from Fed officials that rates will go higher for longer until the pace of inflation is clearly slowing. Chicago Fed President Charles Evans was the latest to spell out the central bank's outlook on Thursday, saying policymakers expect to deliver 125 basis points of rate hikes before year's end, as inflation readings have been disappointing. The market has been slowly getting the Fed's message. There is a likelihood that the Fed, with further rate hikes, pushes the economy into a recession in order to bring inflation down. The S&P 500 has declined 22% from its peak on 3rd of January. Despite the day's decline, the three major indices were poised to post a weekly gain after the sharp rally on Monday and Tuesday. The labour market remains tight even as demand begins to cool amid higher rates. Money markets are pricing in an almost 86% chance of a fourth straight 75 basis point rate hike when policymakers meet on 1st to 2nd of November. 10 of the 11 major S&P 500 sectors fell, led by a 3.3% decline in real estate. Other indices also fell, including semiconductors, small caps, and Dow transports. The Dow Jones fell 1.15%, the S&P lost 1.02%, and the Nasdaq dropped 0.68%. The GBPUSD extends its losses to 2 consecutive days, testing the 115 area. Euro-dollar is below 0.98.
This is today's market news. Thanks for listening. We'll see you next time.